Hi everyone, this is the second video of redemption of preference shares chapter. Now in this video we are going to see the journal entries of this chapter, and we are also going to see the accounting technique that we have to use to solve the problems of this chapter, right? And in the previous video we saw the concept of this chapter and we understood the meaning of redemption of preference shares, right? So what is redemption of preference shares? It is nothing but repayment of preference share capital. What? Repayment, that's it. Okay, that's it, don't confuse it. It's just repayment of preference share capital. And we also discussed about the section 55 of the Indian Companies Act 2013 in very much detail. Okay, so you must watch the first video to understand the section 55 of the Indian Companies Act 2013, which is very essential for this chapter, right? We saw that only fully paid shares can be redeemed, and we saw that preference shares can be redeemed out of only fresh issue of shares, out of profits, or combination of those two. And then we saw how to arrange the money for the extra payment that we are going to pay, we might pay on redemption, that is called premium, the extra payment. So how are we going to bring money for that? And there was also an amendment here which is not applicable to the BCom students. It is not updated in the BCom syllabus. So all that you have to watch the first video to understand all that, because here we cannot discuss all that and waste time on this, because here we have to focus on the journal entries. And most importantly, we saw that the total capital should be intact even after the redemption of preference shares. The total capital in the sense equity capital and the preference capital should be same. But of course preference share capital will go out, right? You are repaying them, so they will no longer gonna be there, but still the total capital has to be same. So how can we do that? How can the total capital can be same? We saw we can do fresh issue of equity shares, or what we can do is we can transfer free reserves into a special account called as special reserves called as CRR, capital redemption reserves, which will ultimately get converted into share capital by issue of bonus shares. So the total capital will remain same like that. Okay, so to understand all these you must watch the previous video, the first video of this chapter, okay, because it is very very important, right? Okay, then so now let's go to the journal entries and let's see how to pass the journal entries, right? Okay, then so let's do journal entries. Now before going to the journal entries, let's just refresh our mind and recall these traditional golden rules of debit and credit. Yeah, we have three types of accounts: real account, personal account, and nominal account. Real account, debit what comes in, credit what goes out. And then personal account, debit the receiver, credit the giver. And then nominal account, debit all expenses and losses, credit all incomes and gains. Yeah, these are the golden rules of debits and credits, but these are not that much important, whereas the modern rules of debit and credit, which is very important. Okay, you must know this. This is very simple. Yeah, so the asset and liability. See here, you must have a notion that the rule of asset and liability are exactly opposite. Okay, there are two groups here. One is asset group and one is liability group. See here properly. Okay, one is asset group and one is liability group. In asset group there is asset and expense. Okay, the rule of asset and expense is same. If asset increases, debit. If expense increases, debit. Yeah, if asset decreases, you have to credit. If expense decreases, you have to credit, like that. Yeah, and in the liability group there is liability, income, and equity or capital. Okay, whatever, equity slash capital, income slash revenue, the same thing. Yeah, so two groups, asset and liability, they are exactly opposite. Whenever asset increases, you debit. Whenever asset decreases, you credit. Whenever liability decreases, you debit. Whenever liability increases, you credit. Simple. Yeah, these are the simple rules of debit and credit. We will use these rules, okay, because we are passing journal entries. So I'm just starting with very basic over here. So let's see the journal entries and let's see how to do redemption of preference shares. Now here we have the journal entries of this chapter. See here, it's very simple. Here we have got 5 main journal entries relating to redemption of preference shares. And then depending upon the question, you might also get some extra entries. You might have to pass some extra entries, and those extra entries are very 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 simple, because those extra entries you're already familiar with them since 12th standard. Okay, like asset is sold. Yeah, asset is sold, investment is sold to bring the cash. Yeah, and then what do you say, share capital entries such as making the call and then receiving the call money and if there are any calls in arrears, like that. So these are simple entries, but still we are going to see them, right? So the extra entries, I have taken them in this red squares. As you can see, these are the extra entries. Yeah, so let's start. It's very simple. So in the previous video in section 55, we saw that only fully paid shares can be redeemed. No partly paid up shares can be redeemed, right? The preference shares has to be fully paid up. Only then we can start the procedure of redemption of preference shares, the procedure of repayment of preference share capital. Yes. So if in the question you have been given partly paid up shares such as preference share capital rupees 9 paid up of face value 10 each, then what you have to do, you have to make the final call, right? We make the calls, right? So you have to make the final call and you have to assume all the money has been received. Yeah, you have to make the call and you have to assume all the money has been received unless otherwise mentioned in the question, right? So you have to make the call due. So how do you do that? It's very simple. Preference share final call account debit. Yeah, you're asking the money on final call. So preference share final call account debit to preference share capital account. Here what you are doing is, here you are making the final call due. You're calling the preference shareholders to pay the money, right? So here we are increasing the preference share capital by the remaining the call money, right? So we are increasing that capital. So if you want to increase the capital, you have to credit the capital to preference share capital account, credit. Yeah, so you're increasing the capital because you are gonna receive, not received, you are gonna receive money on preference share final call account. You're gonna receive. So if you're gonna receive, then this become like an asset to you, right? Preference share final call account. So that is why it has been debited. You are gonna receive the money on account of preference share final call account, and that money will go to preference share capital account. So capital account has been increasing. If you want to increase the capital account, you have to credit that. Simple, capital increase, credit. So you will pass that entry, the due entry, and then you are gonna assume that all the money has been received. So if you receive the money, bank account is increasing, asset is increasing. So if asset increases, what you do? You debit. Yeah, bank account debit, money is coming in. You are receiving money on account of preference share final call account, and you're closing off this account. Yeah, here this account was debited. We were supposed to receive the money. Here we receive the money. So debit is equal to credit. The account is closed off. Okay, bank account debit to preference share final call account. We have received the money on account of final call. Simple. So this is what you have to do if calls are not made. It will be given to you in the question. And then if the question says if there are any calls in arrears, right? If there are any outstanding money by the shareholders, by the preference shareholders, then you have to assume that we have received all the money that was due on calls in arrears, right? So simple calls in arrears entry, bank account debit. Again, we have received the money on account of calls in arrears. We are closing off this account, right? When calls in arrears happens, we debit that, right? So now here we are going to credit that and we are going to close that account. Simple. How much money we have received, like whatever that was pending, just debit is equal to credit here. Okay, bank account, this much money we have received, and then credit the same amount to calls in arrears account. Simple. This is the calls in arrears entry. Yeah, simple, right? So these are the extra entries that you might have to pass to make the shares fully paid up, right? This is the extra entry. Now let's start the entries of redemption of preference shares, right? Let's do that. Now here we have the first entry, the first main entry, see here. But before that, let's understand this equation, this technique of redemption of preference shares. See, it's very simple. What are we doing over here? Here we are repaying the preference shareholders, right? We are doing a redemption of preference share capital. So what is happening over here is we have to pay these guys. We have to pay these guys. So at first we have to accept as a company that we have to pay to these guys and we have to make an entry for that. And that entry is called making preference capital due. Due for what? Due for redemption. We have to pay them. So as I said before that we might pay them something extra also on redemption, and that extra payment is called premium, right? These are preference shareholders, PSH. So what are we going to pay them on redemption? Their capital back, and we might also pay them something extra that is called premium. Okay, it is not mandatory. Sometimes we may, sometimes we may not. Okay, so that is what. So this is the first entry itself. Okay, preference share capital, PSC plus premium. These two things we are going to pay them to whom? To preference shareholders, PSH, right? See, it's very simple. The entry is the redemption of preference shares can be at par. Okay, at par means we are just paying them the capital, that's it, and at premium means we are also paying them something extra. Okay, so this is the entry itself, the first entry, due entry. Okay, see here, how do we pass this entry? It's very simple. Preference share capital account debit. Why are we debiting? Why are we debiting preference share capital account? Because we are making the redemption. This capital, preference share capital, is no longer gonna be there on our balance sheet. We have to scrap this off. We have to remove the capital now because we are paying the preference shareholders, right? So this, in this due entry, we are reducing the capital. So to reduce the capital, you have to debit the capital. To reduce the capital, you have to debit it. Simple. So preference share capital account debit to preference shareholders account. Right? Here you are accepting that you have to pay to whom? To preference shareholders. So that is why you are crediting them. The liability of the company is increasing. If the liability increases, you credit that. If liability is increasing, you credit that. Right? So to preference shareholders account. This is a personal account here. Okay? Preference shareholders account. We are transferring the liability to a personal preference shareholders account. That's simple. This liability is increasing, credit. Here capital is decreasing, debit. That's it. And here also the same entry. See here, if redeemed at premium. Here, as I said, we are paying them something extra. So you're gonna take that also. Preference share capital account debit, and here you are gonna take face value. Okay, only face values, right? So here preference share capital account debit by the face value. We are decreasing the capital. The same procedure as here, right? Either we are gonna do the redemption at par or premium. Okay, not both the entries, any one of them. Yeah. So preference share capital account debit. We are reducing the capital. Premium on redemption of preference share account. Yeah, we are also paying premium to these guys. Here we are just paying capital to these guys, to preference shareholders. Here we are paying their capital back as well as some extra payment. So that is also we have to debit. Okay, premium on redemption of preference shares account to preference shareholders account. Same, liability is increasing, the liability of preference shareholders account, because here we are accepting we have to pay to preference shareholders account, right? So this is the due entry that you have to pass. Okay, simple, right? Yeah, the first entry is this. Fine. Then the second entry is, see here, the main thing that we discussed in the section 55 of the Indian Companies Act is the premium that is payable on redemption, right? The extra payment, this extra payment. Now here you have debited this, right? So you have to write off this, or you have to adjust this. You have to bring the money, that extra money that you're gonna pay. For example, let's say 3 lakh capital was there, okay, to be redeemed, and then let's say you are also giving 30,000 extra to these guys, to preference shareholders. Yeah, in total you are giving 3,30,000. So now from where this money is gonna come, this 30,000 rupees, from where it gonna come? It has to come out of free reserves. It has to come out of free reserve. Free reserves in the sense profit and loss, general reserve, dividend equalization reserve, investment allowance reserves. All these reserves you have to use to bring the money for premium. Okay, you cannot use securities premium, that special reserve. You cannot use that. You cannot use capital reserve. You cannot use anything. You can only use free reserve, the reserves that are available for distribution as dividends. Yes. So we saw in the section 55 of the Indian Companies Act 2013 that to the companies which have objective of earning profit, yeah, on them section 133 applies. What is section 133? Section 133 says that you have to follow the accounting standards prescribed by the Indian Companies Act 2013 if your company has an objective of earning profit, and all the companies have objective of earning profit. So if your company comes under this category, then you cannot use securities premium to bring extra money that is payable on redemption. You have to use only free reserves. Okay, you can only use profits in the sense free reserves. You cannot use this special reserve. You know this special reserve, right? Securities premium. Yeah, you cannot use this reserve, securities premium. Okay, but in the BCom syllabus, it is still not updated. They are using both. They're using profits, free reserves, as well as this securities premium reserve. Okay, that is wrong because there has been amendment here. Okay, in the previous year there has been an amendment, so you have to follow that amendment. Okay, if you're a BCom BBA student, then you might have to pass a note down below and you have to say that section 133 applies on this company, right? And there has been an amendment in the section 55, so we cannot use the securities premium and you have to use only free reserves. Okay, ask your sir regarding that. And there's one more thing here, section 133 doesn't apply on which companies? The companies which doesn't have objective of earning profit, such as NGOs, social companies. Yeah, they don't have to follow accounting standards, so they can use free reserves as well as securities premium reserves. But in coming videos, we are going to go with the first category. We are going to consider all the companies, on all the companies section 133 applies, and that is the real thing. Section 133 applies on all the companies, so we have to follow the accounting standards and we cannot use securities premium. Okay, all of our question will be based on this category, and we will not use securities premium, this reserve, to bring the money for this extra payment. Simple, right? You can only use free reserve. That's it. That's the conclusion. You cannot use securities premium reserves. You can only use free reserves to bring the money for this premium, right? So the second entry is adjustment of premium on redemption. The second entry is to bring the money for this premium. And from where are you going to bring? You are going to bring from free reserves. Okay. See, it's very simple. Profit and loss account, debit. You are going to use this reserve, this profit and loss surplus. Yeah. This credit balance. So profit and loss account has credit balance, yeah, profit. So now you're going to debit that because you're using it, so you have to debit it. Okay, it's a reserve, right? It has a credit balance, so you will debit it. Okay, it's like an equity. Okay, it's like an equity, so you're reducing it. Yeah, you're using it for the premium on redemption, so you have to debit it. You are decreasing that. You are decreasing profit and loss account, that profit, so you have to debit it. Okay, because you have to decrease that, right? So debit that to premium on redemption of preference shares account. Why is this credited premium on redemption? Because here it was debited premium on redemption of preference shares account. You are writing it off, you are closing it off, you are scrapping it off. Okay, so you are bringing money for that, so you have to credit here. Okay, debit is equal to credit, that account is closed. Fine. So that is the thing about the adjustment of premium on redemption. And then what we saw in the section 55 of the Indian Companies Act 2013, that the total capital of the company, total capital in the sense equity plus preference share capital, the total capital of the company should be same even after redemption of preference shares. This is the requirement of section 55 of the Indian Companies Act. Why is this a requirement? Because we have to comply with this. The total capital of the company should be same. For example, in the balance sheet, let's say equity shares was 100, preference shares was 100. In total, your company had 200 capital. Yeah. So after the redemption, what will happen in the balance sheet? You will not be able to show preference share capital. Yeah. Only equity will be there 100. So what will happen? Your total capital will come down. As soon as your total capital comes down, your company will become risky, because the financial leverage of your company will rise and your company will become risky, and there will be a problem in the market. Right, in the stock exchange and everywhere, there will be a problem. Your company will be seen very risky. So what you have to do is you have to comply with the section 55, which says the total capital should be same. But how can we keep it same? Preference share capital is going out. Yeah, only 100 is there. Just for an example. Yeah, preference share capital, you are paying the preference share, so preference share is not going to be there. So what you have to do, you have to replace the preference capital. If preference capital is going out, you have to replace the preference capital. Yeah, so there are two ways to do that. The first way is fresh issue of equity shares. If preference shares are going, bring more equity shares. If preference shares are going, bring more equity shares so that the balance can be maintained. Okay, replacement of capital. So you have to replace the capital, and you can do that by fresh issue of equity shares to the equivalent to the preference shares redeemed, only the face value. Okay, for example, I'm just gonna give you an example. See here, if 3 lakh is going out, you're redeeming them, then what you have to do, you have to replace this 3 lakh by something else, by fresh issue of equity shares. And one more thing that you can do is you can transfer the free reserves to a special account called as special reserve called as capital redemption reserve. Okay, which will ultimately get converted into share capital, because this reserve is a special reserve which can only be used to issue bonus shares, free shares. Okay, so ultimately this will get converted into share capital and the balance would be maintained, and you have to comply with that. You have to comply with this section 55. Okay, the total capital has to be same. So you can do that either by transferring free reserves to CRR or making a fresh issue. Okay, if 3 lakh is going out, either you have to make fresh issue or you have to transfer free reserves to a special account called as CRR, capital redemption reserve, which will ultimately get converted into share capital, so the balance will be maintained. Okay, don't you worry, it's very simple, right? How? By bonus issue. Okay, because that capital redemption reserve can only be used for bonus issue. Fine. So this is what you have to do. So what is the entry? Tell us the entry, sir. Please tell us the entry. See, this entry is very simple. See here, what you have to do. If you are redeeming this face value, only face value, okay, we are concerned of, not premium. We don't have to replace premium. If you are paying premium, that's fine. Bring that money from free reserves and that's done. Okay, that's the second entry that we just saw, right? But here what you have to do, here you have to replace this 3 lakh by either fresh issue or free reserves or a combination of these two. Okay, if 3 lakh is going out, more 3 lakh, right? The replacement should come into the business, into the company, either by fresh issue or either by free reserves into CRR. Okay, we have discussed this in detail in the previous video, but here also I am discussing this. See here, what you have to do, you have to create CRR. What is CRR? Capital redemption reserve. You have to transfer the money. Just for an example, if we are redeeming 3 lakh of face value preference share capital, then let's say we are issuing 1 lakh shares, okay, rupees 1 lakh shares, okay, then the remaining 2 lakh has to come out of free reserves so that the balance can be maintained, right? 1 lakh came through fresh issue and 2 lakh came through free reserves. In total, 3 lakh has been replaced. This gone out of the company. Again, this has been replaced by the fresh issue and the free reserve so that the balance can be maintained, the total capital can be intact, as it is the requirement of the section 55 of the Indian Companies Act 2013 that the total capital of the company should be intact. It should be same. Okay, so that is what we are doing over here. Fresh issue or transfer the profit to CRR. Okay, while solving the problem, you will understand this. It's very simple, either fresh issue or free reserves. And one important thing is here, only face value, okay? Only face value you have to replace, only face value. And remember, face value can be replaced only by the face value. Okay, if you are issuing shares, equity shares at premium, that premium cannot replace this. Face value should replace face value. Okay, this also has to be face value. Okay, but you can make issue at premium, but that will not be enough to replace this. Okay, it has to be face value. Don't worry, we'll see that while solving the problem. So that is the thing. So the entry is creation of CRR. You can do CRR, you can transfer the only free reserves to CRR, only free reserves to CRR. So free reserves such as general reserve, profit and loss, dividend equalization reserve, yeah, these are the free reserve, P&L, general reserve, dividend equalization reserve, and then what do you say, investment allowance reserve, yeah, all that you can use to transfer them to the special reserve called as capital redemption reserve. Okay, so these are the reserves. So all reserves have credit balance, yeah, so you are using that, so you are reducing it. So right, so reserves are like what? Equity, right? Shareholders funds. So if you're using it, then it is decreasing, so debit, yeah, so you have to debit that. General reserve account debit, profit and loss account debit to capital redemption reserve account. Here you are creating a new reserve, capital redemption reserve, so you are increasing the reserve over here, so you have to credit that. Yeah, shareholders funds, reserve is a shareholders fund, right? So if it is increasing, equity, if it is increasing, then you have to credit. Simple. Yeah, so that is what capital redemption reserve account will be credited because it is increasing and these guys are decreasing. Yeah, so creation of CRR, you have to create the CRR. Yeah, that is the third entry. The first entry is the due entry. The second entry is making the money for the premium. The third entry is CRR entry, transferring the free reserve profits to CRR, creation of CRR. Okay, that is the third entry. And then the fourth entry is the balance, whatever that is remaining, the maximum replacement should come from free reserves, okay, by creation of CRR. And then the minimum replacement should come out of fresh issue. Okay, fresh issue. So the fresh issue is, see here, simple, the share capital entry. Yeah, you have seen this in 12th standard, right? Bank account debit, we're issuing share capital here, right? Shares, bank account debit to share capital account. Here capital is increasing, money is coming in, we have issued the shares, right? If the issue is at premium, then the entry will be bank account debit to share capital account to securities premium. Here the face value will come in, here the extra money, yeah, the securities premium. The shares can be issued at par as well as premium. If it is issued at par, the entry would be like this, bank account to share capital. If the entry is at premium, if the issue is at premium, then it will be bank account to share capital to securities premium. Fine. So this is the issue of shares, fresh issue of shares. Yeah, why is this done? Replacement of capital. For the replacement of capital, yes, we have to comply with the section 55 of the Indian Companies Act, that total capital should be same, it should be intact even after redemption. So we can only do that by fresh issue or transferring the profit to a special account called as CRR. Right, so that is creation of CRR and fresh issue of shares. Very simple, money is coming in, capital is increasing. If capital increases, you credit. Yeah, capital increases, you credit. Simple. And here securities premium, that is shareholders fund, that is also increasing. Reserve, so that is also increasing, you have to credit. Yeah, equity, that is increasing, credit. Simple. Yeah, and then asset. Yeah, sometime what will happen, sometime to pay off the preference shareholders, we might not have cash, right? So if you don't have cash, then you might have to sell off some assets. So if asset is sold to manage the cash, to bring the cash, then you have to pass these entry. If the asset is sold at par, for example, in the balance sheet, the asset was of 20,000, you sold for 20,000, then what would be the entry? Simple, the asset is going out, money is coming in, bank account to asset account, bank account to asset account. But that will not happen. Mostly assets will be sold at a loss. Okay, if it is at 20,000 in the balance sheet, you might sell it for 15,000. So 5,000 will be lost to you. And you know, all losses are debited, right? So bank account debit, profit and loss account debit. Okay, loss will be debited. So the 5,000 will be debited, right? The money that has come in, it is 15,000 and 5,000 is lost, and the asset book value was 20,000, just for an example. Yeah, so the asset account will be reduced, right? You are selling off the asset as the asset is going out. So money is coming in, asset is going out, and then losses are debited and profit is credited. If you sell asset at a profit, which is very rare, yeah, it might happen, yeah, but it's very rare, right? So bank account to asset account, the same entry, money is coming in, asset is going out, and then all the income or profit is credited. Yeah, nominal account rule, all incomes are credited and all losses are debited, so income will be credited to profit and loss account. Okay, this will be the entry. For example, if you sold an asset of 20,000 for 25,000, then what will happen? You have got money 25,000, bank account debit 25,000, you sold an asset of 20,000 to asset account 20,000, and you have made a profit of 5,000 because you sold the asset for 25, right? So you have made a profit of 5, just for an example, to profit and loss 5,000. Simple. Profit is credited, loss is debited, simple asset entry. Yeah, simple. And then what will happen at last? At last, it is very simple. At last, what will happen? At last, we will make the payment to the preference shareholders. Yeah, preference shareholders account debit. See here, this entry, this was the due entry, right? Here we accepted that we have to pay to the preference shareholders account, so we credited that. Here there was a liability arising. Yeah, liability was arising over here. Now here we are extinguishing, we are scrapping off the liability, we are paying them off. Preference shareholder account debit, preference shareholder account debit to bank account. Simple. So whatever money here you credited, yeah, let's say you said we have to pay 3,30,000, yeah, including the face value as well as the premium, the extra payment, 3,30,000, just for an example. Yeah, the payment entry, the fifth entry is the payment entry, the first entry is the due entry, second entry is the bringing the money for the premium, the third entry is transferring the profit to CRR, special reserve, and then balance out of fresh issue, yeah, to replace the capital, the face value, only face value, and then the last, you're gonna pay them off, 3,30,000, fifth entry, yeah. The main entries we are talking about, not the asset and all, those are the red squares, the extra entries. So here what you're going to do is you are going to pay them off here 3,30,000, right? So you have to pay them. Simple. Preference shareholders account 3,30,000 to bank account 3,30,000. Simple thing. Yeah. Due entry and then adjustment of premium. You cannot use securities premium. Yeah. You can just use only free reserve, such as general reserve, profit and loss, all those. Yeah. To premium and redemption, and then creation of CRR. It's very simple, fresh issue of shares, and then if any asset is sold, these entries, and then payment. That's it. Yeah, so these were the journal entries of redemption of preference shares, and you have to use this equation because it's very easy if you use this equation. Yeah, preference share capital plus premium equal to preference share holders. This is the entry, right? It's this whole entry. Yeah, preference share capital debit, premium and redemption debit to preference shareholders account, and then you follow this sequence. It will be very, very simple for you. Right, now in the next video we're going to solve the problem. Yeah, we're going to start with the simple problems and then we're going to move to the advanced problems. Okay, then see you in the next video.